You know what? Also, happy summer solstice, right? Longest day of the year.
Is that today? I should
That
have
is
known.
today.
Yeah,
Well,
20th.
when we
Yeah.
when we first started building this presentation, we're gonna roll in here, just letting everyone join us. When we first started building this presentation, it was 618 day. You know, we kind of geek out on the technicals of the market and Fibonacci, the golden ratio. That was June 18th, and now today is summer solstice. So, welcome. We should have everyone here. We've got YouTube going on the public side, and we have the investors, portfolio investor, Inside Edge clients going on Vimeo, and we should be all set. So good day to you, sir. How are you?
Good day. How's everyone doing?
Good. Real good. Kyle's telling me he, being a new dad, he's in this fitness kick, and he told me he was hitting the weights, and he's like, I think I kind of destroyed myself and overdid it.
Yeah.
Gotta go easy,
Totally
man. We're getting
overdid it.
old.
And not a lot of recovery sleep time with a 2-month-old.
Yeah, exactly. All right, so we're gonna get rolling. We have a good presentation. I think a lot to go through. It was a good week. It was a highly indecisive week. So much going on the global macro front, geopolitical, obviously, technically in the market, a lot to go through. So we're talking to the public world, again, not within the Inside Edge Capital family, as well as investors. We're going to do what we did last week, and hopefully so far we're off to a pretty good start, where we're going to transition once we get into the client-specific portfolio holdings. We're going to transition out. So should be good. I think we're rolling. And let's see here. We also monitor Slack if you're able to, if Nick is watching, just to see if anything goes awry.
We might not be on Vimeo.
I believe we are. Yeah.
Cool.
Why do you say that?
That's what Nick said. He said we're good. Never mind. We're good to go.
You're killing me, Smalls. All right, let's go. I know, thanks. So it's June 20th, Investors Edge weekly update. Disclosures: we are an independent RIA registered in Saratoga Springs, New York. Past performance not indicative of future results. Consult a professional. This is not investment advice. Unless you are a client with Inside Edge, then I guess it is advice. But if you are not within the Inside Edge family, just seek your own counsel. And these are not expressions of future performance. And what else am I leaving out there, Kyle?
That's good. Just informational. If you want personalized advice, reach out directly, and we're happy to talk.
Well put. Yep. All right. What did we do yesterday? A little fun. We got the kids. Right after this is done, again, one of the reasons we're going to be quick, I have to go right to baseball practice. I coached the 11U travel team. We took all the kids. We rented a bus, and we took the whole team and their parents and their friends. We had 50 people who went down to Yankee Stadium yesterday to break their 6-game losing streak. So that was lucky. They finally won. Judge went 1 for 3, but Carlos Rodon pitched a good whatever. And I know some people like the Yankees. A lot of people don't. We're playing your LA Angels, Kyle.
Yeah. Who do you have?
Yeah. So it was fun. It was a lot of time. I mean, we're tired. A lot went into it, and there may have been some adult beverages consumed that day, but it was a lot of fun. So we got rained on a couple times, and but we made it through. So it was good. So
Yankee dogs.
Yeah.
Do they call them Yankee dogs?
No, I don't think they have a. Okay. I don't think they have a.
No, we have Dodger dogs in LA.
Dodger dogs, yeah.
Yeah, I didn't know if y'all had a name.
No, I think Austin Wells, our catcher, has his own burrito or something like that. But whatever, no, it's good. All right, let's get rolling. Kind of what we had mentioned last week. The whole goal and vision, as we described last week with Inside Edge, is obviously to be full service, fully integrated, comprehensive financial planning, which is Kyle, but then also active management, individual equity management on the portfolio side, which is me, together, we form, I think a pretty complete offering. And then borrowing, taking a page from my last business, which was really just gets discontinued after 13 years, which is just like we're doing here, the video updates, showing you behind the scenes, showing you, what our thought process is and manage the portfolios in real time. So the members area of Inside Edge is now live. Okay, so we have, if you're a investor at Inside Edge, if you're at my.insideedgecapital.com, you have full access to all of the portfolios that your accounts have, which would be 8. You can reach out, obviously, for ongoing tax and financial planning, plus this live stream. So be sure to get in and realize, again, if you want to know what we're thinking in the markets and things we're thinking about doing, this is the spot. And members, investors, you probably have accessed this video from that area anyways, right, Kyle?
Yeah, and then if you get access, you'll get the second half of this video where we do go into more model specific stuff. So that would be, an extra 30 minutes of us deep diving into our models and everything.
Perfect. And I realized I wasn't screen sharing, so there's the Yankees picture. Sorry, I'm a little out of practice with this. There's the Yankee pictures, and then here is the my.insideedge.com. So this is going to be your home here going forward. And again, as much as you want to join us here weekly to figure out what's going on, this is what it is. So the brand new website is live. We worked hard on it. You'll see a few new changes at InsideEdgeCapital.com, and you can certainly get in there. We're proud. It's been a long process of building out the new public-facing website that is now live. Another component to this, and I'm constantly saying it, I'm sorry to take up time with this, but another component of what we do, which I feel is really compelling, is one of the 8 portfolios that I mentioned here that is available in my.insideedgecapital.com is called Active Opportunities, Active Opps for short. And what we're doing is, we have a lot of short-term traders from our other business, Trading Analysis, which after 13 years is discontinued, who are active traders. And they do so with, a small percent of their portfolio, 10, 20% of their portfolio. They're really engaged in the markets. And what they want to do is they want to stay active. So what I'm doing is trading a portfolio called Active Opps. It's quite active. It's aggressive swing trading, position trading in high growth stocks that are trying to lead the market. And we are covering all trade updates through a third party company we're working with called Savvy Trader. Okay, so you can follow as I manage one of those 8 portfolios at Inside Edge called Active Opps. The platform we're using is called Savvy Trader. It's all integrated. It's $300 per year. It's so ridiculously cheap. You get an app, push notification, blah, blah, blah. It's great. And you have full transparency in terms of what exactly I'm doing in Active Opportunities. And again, some investors at Inside Edge have a percent of their capital in Active Opps. It's a way, as I say, to generate more alpha return on the upside in bull markets. Or if we want to hedge very quickly, if the market gets a little overbought and starts to head down, we can quickly be net short in that as well. So again, no more than 10, 20% of the portfolio allocated to Active Opps. So that's the complete picture of what we're doing here at Inside Edge. Again, full transparency, videos, pulling back the curtain, so to speak, to show the process and show you that, the way we manage these markets and the economy, the way I like to think of it, Kyle, is we keep moving ahead down a dark hallway, but we just kind of bounce off the walls, but still keep moving forward. There's nothing more elegant than that. It's like a boxing match, and you try to win the decision after 12 rounds. But that's been what we've done forever. That's what I've done forever, is just show in real time, the imprecise nature of market speculation and economic speculation. Anything to add on that?
Yeah, just to reiterate, the level of communication we're trying to do with the money we're actively managing for our clients is probably more than you would get elsewhere, maybe more than you want, and that's the point. We want to make sure people understand that we're being active with our management of your money. So
yep, and that's a good segue into Riskwise here.
Yeah, so I did an update last week on our risk tolerance software, Riskwise. It's a really nice way to see your portfolio risk in terms of, the actual volatility of it. There's a lot of imprecise measures for volatility out there, calling a portfolio conservative or moderate or aggressive. Those are very broad terms. So this really quantifies the level of risk. And it's done with a number of 1 to 99. And it's kind of like a speed limit. So, Todd, take over for a sec. Get
Sure.
a water.
Yeah, no worries. It's again, what I find a lot is people who come in, traders, especially like a lot of people who've been following us over the years, are active in the market and they think that, they want to take a lot of risk. And of course, the more risk you take, the more potential reward that you have. But when, Kyle puts you through the process and we go through the discovery process of figuring out what this money means to you, what the long-term goals are, we really find out that some people who think they want to tolerate some volatility in the event, the possibility to give themselves the possibility to gain outsized returns, maybe they're more conservative. And, if you understand and can conceptualize your real risk, which is a very personal decision, there's no one right answer for everyone. That's when, that number for 1 to 99 that Kyle relies on so heavily can help us back you into the right mix of portfolios that we offer. And then it allows you to see your goals to completion. When things get bumpy, and things will get bumpy, you don't call us and say, "Oh, I can't handle it. There's too much volatility," and you want to get out at the worst time because that's what can kill your portfolio. So, anything to add on that, or keep moving?
Yeah. So it's a questionnaire, and you can go to the next slide.
Okay.
So it's a questionnaire, and the output is a risk number, and it quantifies your risk with the number itself, which again, it's 1 to 99. 99 would be more growth portfolio, more towards 1. That would be very conservative. So it gives you that risk score. It gives you a range of kind of a volatility range. You can see it in the top right corner there. So risk 75 here, showing that corresponding range of an output in the next 6 months. We like to see that because, people see volatility, day to day, month to month versus over the long term. So what can that model do? Those investments you're in, what can it do over the short term? If we understand that and you're comfortable with that, then we feel more comfortable targeting like a long-term investment plan. So then we know that you're comfortable sitting out that risk or sitting through that risk. And potential volatility, which, we do see in the market, every few years at least.
Probably more frequent now. Hey, here's a question that I actually have for you, like just between you and I. How often do clients come back and revisit the risk analysis? Like life circumstances change, people change, their goals and priorities change. Does it warrant going back through Riskwise and reassessing risk score?
Yeah, absolutely. Some people want to do it every so often, every year. More often, it's when you go through life changes where your relationship with your portfolio changes, whether you're in like heavy accumulation and saving mode. That's going to be a risk score usually. And then when you go more into like consolidation and then taking distributions, your risk number is going to change based on, what your role with that portfolio, with that account is.
Gotcha. Cool. All right. Good stuff. Let me keep going here. Appreciate that. All right. Let's get into the fun stuff. How funny is that picture with Trump and Powell? Oh my gosh.
They're so happy together.
Driving. He literally called him stupid the other day, and he goes, "I should be Fed chair." We're like, "Oh my god." Anyway, here we go. Geopolitics. And I don't mean to laugh. There's obviously some horrible human atrocities happening right now. Some of it's comedy, and some of it's just pure it's horrible. But let's get into the Fed first. We had the Fed on Wednesday, and there were some really interesting headlines, takeaways from the Fed meeting. A few of the key headlines were, tariffs ultimately passed on to the consumer. Powell says he sees no signs of the economy weakening, so he's bullish on the economy, though. And this is one of the key themes you're going to see that's driving the market and the uncertainty and the very range-bound nature of the market, that tariffs will ultimately pass on some inflationary pressure to consumer in the near term. Fed seems willingness to sacrifice employment and GDP growth to keep tariff inflation low. An investor says, Powell says, no one holds rate paths with a great deal of conviction. So basically, they don't know what's going to happen. Tariff fears appear to be driving up near-term inflation expectations. And there's so much, how do I say this, subjective, just it's Friday afternoon. I'm not coming up with the right words here, but tariff fears, emotion, appear to be driving up near-term inflation expectations. So fear of the unknown in the future is what they are saying is going to be elevated inflation pressure. At his press conference, Powell said policymakers are well positioned to wait before moving on rates. He also said we're beginning to see some effects of tariffs on inflation. Okay, so as we just look at where Fed funds are going to be, the market has been on this for so long, waiting for consecutive rate cuts, I would say. Currently, we're at 4.25%, 4.5%. The next Fed meeting is going to be July 30th. Right now, there's an 89%. Actually, I started making this presentation Wednesday. This was from Wednesday. We're at an 89% chance of remaining as is in July, then down to a 73% chance of down a quarter in September. Okay, waiting in October, and then again a 92% chance of going another quarter in December. Since then, June 18th up to June 20th, what's interesting now, and just in the last 2 days, we got some more economic data. It's only 59% collectively that we go down another quarter, but we're tacking on now a 10% chance of going down 50 basis points. So it's all about the Fed, with the fear of the economic slowdown and the fear of inflation expectations spurred from the tariffs. So, we're starting to see a little bit more of the market pricing in rate cuts. And there's a lot here, but I know it's a lot for Friday afternoon, but every Fed meeting, they put out these SEPs. The Fed puts out the summary of economic projections. And what we're looking at here is the inflation expectation, the personal consumption inflation expectations. That's the Fed's preferred measure. And what all this means is the dotted line is where the Fed was in March. So quite literally what we're doing is this is the number of Fed participants where they think inflation is going to be in 2025, the overall average rate of inflation in the year 2025. In March, you look at where that dotted line goes, 10 participants thought that we would be between 2.7 to 2.8 in this year. Then in June, it dropped from 10 to 4. And where did those 6 go? Well, they started to go up here. So now we're looking at 2.9 to 3% inflation in 2025. We were at 4 participants at the March meeting. It doubled up to 8. So basically what they're doing is they're pushing their inflation expectation up for 2025, okay, by 1 to 2/10 because of tariffs. In 2026, the average rate viewed by 10 of the Fed participants by this blue dotted line in March was 2.1 to 2.2. On June 4th, the last meeting, it dropped all the way down to 4. And those 6 jumped up to here, right? We're looking for, again, this is for 2026, next year, the majority of the Fed participants in this dark blue, which again is the June projection, puts us at 2.3 to 2.4 for 2026. And the point is, look at the long-term trend. Look at, even though we're kicking up a 1/10 or 2/10 of a percent of inflation expected in 2026, it's still at 2.1 to 2.3. where the Fed's long-term inflation goal is 2%. So this is what I'm saying is the inflation expectation in the near term is viewed to be kicking up. But here we have even the Fed, which I think is too pessimistic in terms of inflation expectations, down at 2.1 to 2.3. And we're sloping off significantly as we get up to 2.7, 2.93. So even the Fed is viewing the inflation from tariffs to be transitory. As it pertains to GDP, same concept. In March, 8 participants were looking at GDP in 2025 to be 1.4 to 1.5. And then in the June meeting, okay, we went, from here to here, 1.6 to 1.5, call it. So the expectation of growth from the Fed dropped. Okay, so again, look at the dark blue. I know it's hard to follow, but this is where they were in the March meeting, and then actually, let me think about this. Other way around. Am I screwing this up, Kyle? Yeah, no. June was here.
You're right.
And then we went back. Yeah, we're backing up a couple tenths of a percent, 1.4 to 1.6. Mm-hmm. But then when we look forward, we're pretty well balanced. March compared to June, we dropped 4 participants in the 1.8 to 1.9. So, we're still, in the near term, they're looking at GDP being impacted by tariff and macroeconomic events. But then, longer terms, we got to 2026, we're at, 1.6, 1.8, 2%. I think the Fed is just being a little too cautious. Again, fear perhaps is driving their expectations, the fear of the unknown with tariffs. And, I think that might be keeping a cap on the market a little bit. And I think that is why we're seeing 2 rate cuts priced in over the next 6 to 12 months, which, between you and me, Kyle, I don't think, if I had to bet, I don't think we're going to get rate cuts. And I don't think we need rate cuts. I think the Fed is being too pessimistic. Maybe that's just the mandate, an unstated mandate that they have, which is maximum employment and price stability. But it seems like they're being too conservative. Any thoughts on that?
Yeah, I think eventually, in the next probably 2 to 3 months, unless tariffs change a lot, they're going to have to start looking past them. Once the tariffs are input, it should be pretty much a one-time increase on inflation. It shouldn't cause any systemic inflation. So, assuming tariffs don't change a lot, you would think they would kind of stop being so worried about the tariff impact.
Yeah, and we are seeing, a theme, which is reshoring and onshoring that started a while ago, and it is accelerating. Companies are starting to invest in the U.S. to bypass those tariffs. So we shall see. A lot of questions, and I'm not really faulting the Fed. There's way too many unknowns, and that's why the market is trading with such a hesitant, whippy, just an uncommitted, direction right now. The one thing I'm watching too, and this is I've really just started looking at this is the housing market. So I just got into this today, and I don't feel completely prepared to give you a clear takeaway. It's something I'm just starting to consider, and I want to talk it over with Kyle on this and continue to look at. But housing starts have been dropping significantly. So this is new residential construction from 1959 to 2025. These are absolute number of units started. And what's kind of mind-blowing to me is this does not trend. It's sort of a range-bound indicator. Anywhere from, this is thousands of units, so 2,000 units. So I guess that would be 20 million. Please tell me if I'm wrong on that. But, we could see recently that we're starting, or is it 2 million? Come on, smart guy, tell me what I'm looking at here. But you can see that the number of housing starts are dropping. And this is new privately owned housing units started on the right. Again, we've come off, significantly GFC. We've rallied since the global financial crisis up to, just after COVID. Inflation hit, and then the new housing starts have started to really consolidate. And what I also included was population growth on the left side. So, clearly we have population growth, but I would say new housing starts, even, just before the global financial crisis, which was highlighted by a housing collapse, has been in a downtrend. So, obviously we have the biggest is going to be, with the expectation of high inflation from tariffs and, other things that happened before Trump came in. We have interest rates that are high relative to where we've been. The 30 or the U.S. 10-year security is on the right. That's at about 4.25 right now. And you can see the correlation with the 30-year fixed mortgage. The 10-year yield has the biggest impact on where 30-year fixed mortgage goes. So there's also a spread that, this would be like a risk premium that mortgage lenders demand because of the uncertainty in the market. They should be closer. And I track the spread between the 10-year U.S. Treasury yield and mortgage rates. It should be closer, but there's a pretty big spread that's occurred post-COVID and the inflation explosion and rates staying high. So the premium is large. But still we have, mortgage rates we can see right here are in blue on the left scale, which are, still 6.5, 6.75, which is not cheap compared to when we had 3% money on the mortgage rate. So housing is going to continue to come under pressure. And as we go into the members, investors part, there are some home builders that we still hold that I'm watching, and I don't love the performance of them. I'm inclined to cut those positions, but I think the housing market, which is a big component of inflation as it pertains to the Fed's job and when we cut rates, the lack of new housing starts is going to keep housing prices high. But on the other hand, high borrowing costs, are also going to keep some would-be buyers out of the market. So we have to watch the impact of housing values, housing numbers on inflation going forward. And Kyle, interrupt me if there's anything you want to jump in on. And here's the U.S. 10-year yield, just a little bit of a technical chart as we looked at in the last slide, and you can see since beginning of 23, pretty much Q1 of 23. The U.S. 10-year yield is at got down to 3.8 up to 4.6. It's really very range bound. So again, with all the talk of inflation expectation and credit quality and a divesting of international investors in the U.S., taking money out, bringing it back overseas because of our significant debt to GDP and budget deficits and and everything else in tariff policy, rates aren't going anywhere. Technically speaking, looking at price charts on the weekly and the daily, they're very quiet. They're right at 4.25, which I tell you what, with the strength of this economy and the earnings that we're seeing, the innovation, the AI boom that I very much believe we're still in the early innings, I feel like from a macro point of view, yields are pretty quiet. And that brings us to this war, which is horrible. We got to see. Now, there's a lot of conspiracy. There's some conspiracy theory out there. Was Iran about to be a nuclear power? They were enriching uranium at a pretty significant rate. Were they days away from possessing a nuclear weapon? Or did, they and we not, unspecifically saying who they and we are, want a regime change out of Israel, and this is like in Iraq 2.0 where there were no WMDs. I don't know. As it pertains to the markets, we have to watch the Strait of Hormuz and what Iran does. It doesn't seem like Trump is too willing to jump in the middle of this. And does Iran, as a defense, shut down the Strait of Hormuz, which I believe is about 20% of the global oil supply. I've seen estimates that if they were to do that, crude oil would go up anywhere from $7 to $30. Crude oil is about $72 a barrel on West Texas Intermediate. That would obviously be inflationary. Anything you want to jump in there, Kyle?
Yeah, just so much uncertainty and head faking. I mean, it could turn into a real war. It could be like I was thinking of Trump back in 2018, and then I looked it up just to revisit it. But the North Korea Trump was like, my button is nuclear button is bigger than yours, and this whole
and Trump
thing
goes,
that we
and Trump
went
goes,
through.
mine works.
Yeah. And then like how long later was it until they like met in person at the
Right.
demarcation line and like were hanging out? It was
Right.
a total 180.
Right.
So I mean, how can you predict how these things are going to go? It's so I mean and it's the ramifications are huge, but I think um, once all the stakeholders of really the whole world get involved, things kind of get smoothed out over time. If as long as everyone stays cool and doesn't escalate more than to that past that point that it would be hard to back down.
Yep. Yep. And the one thing I've studied, the first and second Gulf Wars, and there is very good precedent to show once the U.S. got involved when Iraq invaded Kuwait, as soon as the U.S. started moving in and sending, I think they were shooting Tomahawk missiles at the time, crude oil sold off and the stock market bottomed that day. And I think it happened the second Gulf War as well. So, would history repeat if the U.S. were to get involved? Would that reverse the macro trends, break the S&P out of the trend that it's in, and start to put a top into crude oil, which we'll talk about later?
Yeah.
Oh, look at this. There you go. You
Yeah,
put this in. There you go.
Yeah, this is just from previous, geopolitical events that, I mean, going from back to Pearl Harbor all the way up to U.S. pulling out of Afghanistan. And the main trend is a lot of the, I guess, effects of these things gets priced in earlier, and the bottom is quick, averaging 19 days, with the recovery taking around 43 days.
So wait, dumb question. What does that mean? On the drone strike, the bottom is within 19 days of that event, on this event date,
right?
And
then of the event date.
Okay.
Yeah.
Got it.
But really, the only one that took, I mean, more than a month was Iraq's invasion of Kuwait. These two here, yeah, Munich and the Tet offensive, which I'll admit I'm not sure what that one is, and then Pearl Harbor. So we're talking about 20 major geopolitical events.
That's interesting. So yeah, it's when Iraq invaded Kuwait, and then actually I'd like to know how soon. It's easy to look up. How soon after did Iraq invade Kuwait? Did the U.S. enter? And then again, I know the market bottomed right there. Crude oil sold off, and stock market bottomed. That's interesting. Good stuff there.
So, just like a company goes through some trouble, they adapt and get back on their feet. So the same thing we see all the time with these. It's, something crazy happens, stakeholders get involved, everyone works towards a solution, and then the market, it sees all this happening. It's as smart as anybody, and it can recognize, like, is this a systemic problem, or is this kind of an isolated event that is getting worked through that we can come back from?
Yeah, and I think it's important to say one thing here, that stepping back from, again, the macro, the geopolitical mess, that's happening right now, and it's been happening for a long time in the Middle East. But, as professional investors, which we are, I think it's important to just remind our investors and clients that it's fine to have a political bias, which most of us do, and side with one side or the other. But you have to be able to compartmentalize and shut off that political and humanitarian bias that's happening in the world when it comes to the markets. The markets are incredibly smart and can discount, and capital is going to flow to where it's best treated, is the famous saying. So you have to be able to shut off your biases, political, humanitarian, or otherwise, as to not blind you to what the market is telling you. And a lot of times you're going to have to invest your money in a direction that is counter to what you think is in your best interest based on those biases. And I think I've been working on that for years, where I have my biases, but I realize the market is very much separate than what I think should happen based on my political biases. So I just remind, and encourage you guys to think about that. Too many people, Kyle, have we seen have taken themselves out of the market because of fear of what they think is going to happen by both the social and traditional media that's beating everyone over the head, or their own political biases where they're so emotional that they can't think rationally. And what is it doing? It's costing them valuable portfolio returns.
Yeah,
I love that smile. I love that smile on your face. Most of our clients have been really good, but we've had some people that have been pissed off lately. Nothing that we're doing, just pissed off at the environment.
It's so hard to put it aside, and things that affect you could be personally. It's easier said than done, but it's a very important lesson as an investor to be able to do that, or to trust someone that can do that for you, and just be able to like see the big picture and all these things.
Right. And it's not IQ, it's EQ. It's emotional intelligence, knowing that you can't know the future, and you have to have insane amount of respect for the unbelievable, massive living organism, which is the market. Capital markets are amazing. What they can sniff out and detect, and how capital goes into some theme that is not being reported on the markets or in the news channels or social media at all. It's amazing how smart markets are, such that nobody can know what they're sniffing out. You just have to set aside and know what you know what you don't, but then also respect the market and hear the message the market's giving you. It's a very intricate, hard to describe point, but I don't know. We'll leave it.
And you could be right. Your opinion could be right, but that doesn't mean that doesn't mean you interpret the market in a certain way. Like it could still be a different story. So being right doesn't always mean good investment decision.
and that's it. I mean, that's it. That's another good point you make. Like, what's more important to your ego, being right or making money? It'd be nice to have both, but it's really cool when you're able to see what your whatever opinion is as to what's happening in the world, set it aside and say, okay, the market doesn't see it the way I do, and then go make money, even though perhaps your biases were wrong. And that's having EQ, not IQ. And if you're wrong, then you got to say, I'm not smarter than the market. Tuck tail, course correct, and get your butt back on track. All right. So crude oil, here's WTI long term going back to 21. We've been in a downtrend. We were up at 130 a barrel. It's amazing. Back in 22, we went down below 50. This is the monthly chart. Here's the weekly chart. We've been holding downtrend resistance on WTI Crude weekly. Here it is on the daily. This is the latest Middle Eastern spike. Try to get above 77. We're back below the breakout downtrend resistance technical line that algos and technical traders will look at is right around here. And that's why the market has been messing around this level. It is a technical significant level. It's a downtrend that has been in place since mid-23. So, it's kind of caught, pun intended, right now between a rock and a hard place. See what I did there? We've got the blue dotted line is support, the white dotted line is resistance. So it's still in a range, and that range is oriented towards a downtrending direction. Tie into the market technicals, complete step aside, putting aside the macro, the economic, the geopolitical, and all that psychological stuff. Let's just look at some fun technical things. And I think it's important that we bring this up to our investors. And I know a lot of people who know me from my old life at trading analysis know I like to look at the charts and do some real geeky stuff here. This was really cool. So the 2022 drop in the S&P 500 from the inflation and interest rate spike was 132 SPY points. So, this is the tracking stock of the S&P 500. Did you know, Kyle, that the April sell-off was also 132 points? I
did not. That is news to me.
Isn't that bonkers?
Yeah.
Okay. So I'll do you one better. So from COVID lows up to the 2022 highs was 261 SPY points. Sold off We embarked on a new rally at the end of 22, 265 S&P points. What's the point here, Mark? There is some rhyme in order to it all. It doesn't always happen, but these kind of relationships do happen, and it's pretty wild. So we sold off, and then we're coming back. All right. Another thing I like to do is I like to project percentages, and a lot of times a prior significant market swing, once it's tested again, the market will acknowledge it. So we did a 120% swing in the S&P 500 from 2020 to 2022. Another 120% swing projects 763 in the market as we're trading 602. I believe that's about 19%, I think, from current levels. So just mark that in your calendar. Now, again, and I know Kyle's dad likes Fibonacci as well. He's a technical guy. The 61%, and that was that June 618 golden ratio Da Vinci Code thing. 61% of this rally has been this line right here, which the market's been messing around since the middle of last year. So if we embark on the upside, I really want to be watching that 763. This is the technology ETF XLK. This has all the biggest technology stocks in the land. A similar concept. So you take the percent swing here from COVID to 22, project up again, 618 has been here, 100% equal leg move is 293 in XLK. You look at this top, this is a real simple idea, but when a market tries to break through a ceiling or a floor a third time, so they tried once, tried second time, tried a third time, a lot of times on the third time, they get it. And the market really wants to break through. So 293 is something that I'll be watching on XLK. I do think despite all the macro and geopolitical headwinds, when a market, technically speaking, is trying a third time, it wants it. This was done about a week ago, I think. This is updated right off the right into the close here today. We have backed off a little bit. This is the S&P 500 on the daily. This is the last 10 trading days. We've backed off a little bit. And again, what is it doing? It's trying to break through this 1, 2 triple top here. This goes back into the middle of 24, and this year, this is a significant level. So it's not uncommon to back away a little bit. I'm contemplating putting a little protection in the portfolios. I don't know how far this reaction from the all-time breakout is going to go, but I'm watching closely. I don't think it gets too much below these two moving average, the purple and blue line. I'm going to watch to see. We might have some hedging opportunities, but it's day by day here. But I do ultimately think once the market bottoms, I believe that we should be able to break out that triple top and bring us up to new highs. Gold's a tough one. It's a long discussion. Gold can move higher for a variety of reasons. And again, I'm kind of appeasing some of my technical people from the old life who have really studied this. I think gold continues to move higher. We do have some gold miners exposure. Gold can move higher either based on the US dollar and interest rates going lower, which generally also supports the stock market. Gold can go higher along with the stock market based on, again, lower US dollar, lower US yields. Doesn't seem like the Fed is in too much of a hurry to cut rates because of the fear of inflation as we started. But we also can move up based on geopolitical fear. And, obviously wartime, gold tends to be a safe haven. So, I'm looking at some upside levels in gold. I'm not pounding the table on any manner at all here. Gold also has a triple top here on the daily. So this is GLD. This is the stock that tracks gold. 1, 2, 3 top here in 2025 over the last 6 months. So I'm watching what message gold gives to the broader market. And if you're sort of a more passive investor and you're not really into the technicals and really getting into the relationships that we do in my prior life, don't sweat it. If there's a clear relationship with gold and the broader stock market, I will bring it to your attention. But right now, gold is trying to decide, is it rallying based on lower rates, lower dollar, in a risk-on pro-growth environment, or is it trying to be a safe haven bid in wartime and uncertain times like we have now? I will let you know if I have an idea. I think this is the last one. Junk bonds. Normally, junk bonds will sell off if the fear and there's a growth slowdown, inflation scare. Junk bonds would sell off just like they did here in April, right? We had that big stock market sell off in the beginning of 2025. What's junk bonds doing, Kyle? And I was surprised when I saw this today. All of a sudden, J&K is trying to break through this white resistance line. Junk bonds are being bought up, and those are the higher yielding, double B and less corporate securities that wouldn't be bought if the outlook is negative going forward. So if J&K, which is a stock that you can track, if it breaks above $80, you would say that the resistance here on the weekly and daily has been broken. And again, fixed income investors looking for a higher yield than what you can get in treasuries wouldn't be moving into J&K unless they thought something was going on there.
Mm-hmm. Yeah, it's curious.
Interesting, right?
Yeah, no, totally.
Okay, we're going to move. We're going to say goodbye to the public, and we're going to move into investors only. So thanks so much for hanging out. We're going to get into the investors only here, talk about some portfolio stuff. And thanks for joining us here Friday. Have a great weekend. And,
have a good weekend.
Yeah, we'll talk to you guys soon. All right, let me just shut this stream off.